Well, the U.S. economy remains red hot. Fourth quarter GDP came in hotter than expected, growing at an annualized rate of 3.3% versus the 2% that was expected. We've got Michelle Girard, NatWest Global Economics Head of U.S. Michelle, let me get your reaction to the number that we got today and to what extent this alleviates some of those recession concerns.
Well, again, another report that beat expectations, beat our own expectations. We had thought we'd be closer to 1.5%. I think in particular, more good news about the consumer here. I mean, it wasn't just a component like, for example, the fact we had a smaller drawdown in inventories. Inventories were expected to be a drag on the number. They're up. If you look at some of the numbers, particularly, as I said, the strength of the beat on the consumer side, it continues to suggest ongoing resilience. And coupled with that, though, good news on inflation. The inflation numbers were in line or perhaps even slightly lower than expected. So for markets, a great combination where you're still seeing economic resilience, but not the inflation pressures. And so you've got almost a best of all worlds or a Goldilocks type of scenario with these numbers.
So, Michelle, what do you think will be the turning point? Obviously, the consumer's not going to keep spending forever. They've blown through all their pandemic savings and still seeing that credit card debt continuing to mount up. What do you think is going to be the turning point here?
Oh, I wish I knew, because I have to say we have been very skeptical about the ongoing strength of the consumer and the broader economy for, to be honest, far too long. We actually thought we might be already in a recession, and the data, as reported, just continued to come in stronger, whether we're talking about GDP or the retail sales figures, or, just it seems like report after report, the numbers look stronger, despite, as you've noted, some cracks that are appearing, I think, in some of the more anecdotal or survey evidence or evidence of delinquency rates ticking up. I think this morning we saw more evidence with the surveys of regional manufacturing activity coming down, being weaker. Beige Book has cited problems. And I even think in the employment report that looked healthier, the underlying news in that report from last month was not as strong as it appears. So I think the consumer is going to continue to be pressured. As you said, savings are gone. They've benefited from real earnings, inflation adjusted earnings being higher. But as the labor market loosens, as companies, I think, pull back on hiring and some of that strength sort of dissipates, I do think you're going to see a softer consumer and overall economy. We do think we'll be in a recession by the middle of 2024.
So, Michelle, with all those factors you just mentioned, how much support do you think the U.S. economy needs in the form of monetary policy to keep this kind of momentum going? Are we talking about 2 rate cuts, 3 rate cuts? I mean, how do you sort of break that down?
So, the market is looking for, a lot of rate cuts to begin, maybe March. I think some of that expectation now has been pushed off a bit. But the market is looking for the Fed to cut rates 5 times or more in 2024. With our recession forecast, we actually think the Fed could be more aggressive than that, cutting perhaps twice as much, getting the funds rate back down to 3 or 3.25%. And it's really not so much about the Fed needing to step on the gas, if you will, to try to help the economy, because again, the economy is showing resilience. It's really more about, with inflation basically kind of at or getting back very close to target, we think it's going to be back to 2% by the spring. Do you really need the funds rate to be up at 5.5%, to be so jammed on the brakes? And so it's really more about the argument for, when does the Fed feel they should start to take their foot off the brake to give the economy rather a little bit more ability, less of a strong headwind to continue to grow and hopefully, again, avoid a recession.
And so,
Michelle, we have gotten a string of announcements this week coming in, particularly out of tech companies, of additional layoffs. What we've been trying to figure out is how much of this is specific to tech, about this massive buildup in hiring they saw during the pandemic. How much of this is a sign of things to come? How are you looking at it?
Yeah, I think that there's a broader weakening in the labor market beyond just tech. I referenced the fact that in the December employment report, where the headline looked pretty good, there were some worrisome signs in the more detailed data. I also, on that same day, we had an anecdotal survey of non-manufacturing industries or companies, and in that report, we saw a big hit to the number of companies saying that they were going to be hiring workers and the employment, kind of the employment there. And so I do think there is evidence that we're seeing more caution on the part of companies to be hiring. And I do think that the employment data themselves are going to, at those headline numbers, are going to start to weaken. And it's that kind of fundamental continuing easing of labor market conditions that'll ultimately probably undermine the consumer.
And of course, Michelle, U.S. economy not operating in a silo here. So as we look at what other central banks are doing, especially the ECB, in their conversations, they weren't even thinking about a rate cut. How should we be viewing some of these external issues and how that affects the moves that the Fed could be making?
Well, I think what we're seeing globally is that all central banks are starting to, the major central banks are shifting from tightening through much of 2023 to easing in 2024. And the question is how much and when. The ECB was kind of widely expected to be the first ones to cut. Markets were pricing in cuts as soon as March. The last few weeks, the ECB has really, I think, pushed back against that. But this morning, they left rates unchanged as expected. But the press conference was a little bit more dovish and seemed to perhaps open the door for rate cuts in March or in April. At this point, we're still expecting that it may, or I think we assign highest probability, I would say, to the rate cuts maybe not starting till the summer, although we acknowledge it could come earlier, and then maybe more aggressively, a 50 basis point cut rather than 25. But I think what we're going to be seeing is all central banks, whether it's the ECB, BOE, or the Fed, are this year going to be looking from moving policy from a very restrictive stance with interest rates well above their so-called neutral level to now, with inflation more in check, coming back, lowering those rates back at least to a level where they're not hurting the economy or hindering the economy nor boosting it.
Certainly a balancing act there. They're all continuing to try and follow.
Exactly.
Appreciate you taking the time for joining us, Michelle
Thanks so
Girard,
much.
NatWest Global Economics Head of US. Thank you.